Prakash Jha, the head of compliance and legal WazirX. I would request all the delegates to keep posting their questions in the chat box. The panel may pick up a few in the end and answer to your queries. Over to you, Mr. Rastogi.
Thank you, Swati, and good morning, everyone. I'm really happy to have these three panelists here, Sunil, Shashi, and Sam. I think we'll be able to draw some very rich insights. They're also coming from, kind of different areas of expertise and bring different perspectives. Sunil and I have spent many panels like these together, and I've always really enjoyed listening to him, given the kind of intense, academic rigor he brings to any discussion, and really does understand this subject very well from a global and localized perspective. Sam has been, entrenched in the fintech ecosystem for a long while, and really understands tech. Is now the CTO at ZebPay, and I think brings both a local and an international flavor, which I'm looking forward to discuss. Shashi, head of compliance and legal at WazirX, not an enviable job. I think as a lawyer like myself would very much understand it's a challenging space from a legal regulatory policy perspective and a compliance perspective. So I think your insights on how to regulate stablecoins, legal and policy challenges there, compliance challenges would be very interesting. So with that, I'm going to start out, and I think the one personal agenda I've set out for myself, one mystery that I would like to kind of try solve with all of you on the panel today is how do stablecoins and CBDCs, how can they coexist together, right? I mean, with this whole phenomena of different central bankers coming together and speaking of, launching their own CBDCs over the next couple of years, where is there a space still for private stablecoins? What kind of innovation are we going to see in that space? What kind of opportunities lie there, et cetera, right? And the way to start that conversation out, I think, is let's just first try and understand what are stablecoins. How do they differ from CBDCs and other altcoins? So maybe if we could start with Sunil, Shashi, and Sam in that order, and yeah, over to you. So.
Thank you, Anirudh. I think before we define what is a stable coin and a CBDC, we need to put it into a historical context. If we go around 70 to 80 years back, when central banks started functioning, the best job that they could do was printing money. But there was needed a last mile distributor for that currency, and that's where they needed network of branches, and that was where commercial banks actually came in. And that system created fractionalism of banking system, and that more or less that system is now default banking system across the world. But remember, central banks needed network of bank branches. That's the key. Now come down to 2020-21, you will see that here that network of branches is being replaced by new kinds of networks, particularly crypto networks, particularly on-chain networks, cross-chain networks, and hence cross-border networks, which means that this is a context where there are two choices. Two choices means that either a central bank will have to build its own network currency, because primarily all the currencies are territorial currencies. They are not network currencies, which means on-chain currencies. If central bank doesn't do that, then there would be some other players. Whether they will be regulated players or unregulated players, that's a different matter. So stable coins are CBDCs by proxy, not in reality. So my understanding here is that in last few years, at least in last 5-6 years, coins like Tether, TUSD, and multiple other coins have emerged just fill that regulatory vacuum, because central banks or commercial banks did not do anything tangible in terms of regulatory framework. So that space was always vacant. So that space has been now captured by primarily three kinds of coins. One is centralized issued coins like Tether, then by algorithmic coins like Nubits, and then there are over collateralized coins, but in a again in a partially algorithmic manner like MakerDAO issued DAI. So the issue here is that three different versions of stable coins have emerged, and now they are basically doing banking by proxy, a full reserve banking by proxy. So this is a unique kind of a historical vantage point where the road forward has to be pro innovation. And that's where regulators will have to take that step, which means either they will have to build a new kind of regulatory framework for stable coins, or they will have to build their own on-chain network currency.
That's fascinating, Sunil. Thank you for the historical context to this. Shashi, over to you. How would you define stablecoins and distinguish them from others?
Yeah, like Sunil was mentioning, stablecoins have emerged over the years as banking by proxy or currencies by proxy. But rather than getting issued by any sovereign or any central banking system, it's being issued from private players. Obviously, in terms of the characteristic, they mimic any fiat currency. However, they have their own unique characteristics in terms of, they allow rapid transfers of value across the globe, maintaining the price stability compared to other cryptocurrencies. While fiat currencies also do the same to some extent, they are by their inherent structure very inefficient, both in terms of time taken to transfer as well as the costs involved. And at times, since they are centrally issued and centrally controlled, they are monitored very, very tightly and very closely by some of the banks, especially in a country like India where capital control is still there. So stable coins have a very unique place, and we believe that over a period of time, there would be some sort of regulation that would put more accountability around some of the inherent requirements of having any kind of currency that is transparent and auditable in terms of their structure, reserves, etc. Yeah.
Okay. Interesting. Sam?
Yeah, thank you both. It's a really great explanation. I think between the three of us, at the end of this session, there should be no question about what is a stable coin and cryptocurrency. I think we're going to cover it from three different angles. So I'm going to come at it from a slightly different angle. I love defining terms. So when we talk about cryptocurrency, I think everybody understands cryptocurrency. It's a blockchain-based digital currency. As cryptocurrencies came around and people started using them, we realized that actually, this decentralization is really nice, but the volatility isn't so practical. We need a way to solve this. If I get paid in Bitcoin, and we saw that kind of market correction yesterday, suddenly my time is now much less or much more valuable than it was. So it's kind of really hard to work with that. So the idea was that let's bring in something that is stable, that is pegged to something in the real world, something that's tangible, such as the USD or the price of gold, some kind of asset that is there. And by doing that, we now solve the volatility issue. We still have an element of decentralization, so that we can now continue working with this in the same ecosystem within the blockchain, similar to something like if Zomato were to issue a gift voucher. That could be a stable coin. It's only kind of useful within the Zomato ecosystem, as USDT is only useful within the USDT ecosystem, which is it's kind of big, but it's still just there. It's backed by Zomato, so you trust that Zomato, they're not going to run away with your money. You can still use this 200 rupee voucher. That would be the equivalent. It's backed by something. Now, there is an issue there in that it's a stable coin, it's asset backed, but it's not heavily regulated. This whole industry isn't regulated. It's not. There's not a lot of compliance in there. We're not 100% sure if there is a one-to-one backing of every USDT that's issued, because of this lack of regulation. USDC brought in GT, Grant Thornton, to come in and help kind of prove that they are covering all of the value that they're issuing, but it's still, it's in an unregulated space. So that's where CBDCs come in, which is that kind of another level of stablecoin where we're basically just adding in that kind of that regulation and compliance level. So we're kind of making it a bit more serious, a bit more controlled. They're owned and kind of handled by the banks, which are licensed, regulated, trustworthy authorities. We trust them that, for every piece of value they issue, they have something behind the scenes to back that up. And this we could think of in terms of something like Paytm, which it's almost a kind of digital rupee in today's world. Ola and Uber and all of these guys have digital wallets where it's kind of fungible. You have 100 rupees in your wallet. It's backed by a licensed authority. You can use that 100 rupees in almost everywhere you go. And that would be a kind of a good analogy for CBDC. So cryptocurrency, stablecoin, asset-backed, try to make things less volatile. CBDC takes that and adds a bit more regulation into it.
Interesting. So I'm going back to something that Sunil brought about, which is that the reason we have stable coins, this phenomena today, is because central banks have somewhat failed to deliver on the promise of CBDCs till date, right? We are still at a place where most central bankers are still only in very, very early stages of piloting or conceptualizing a pilot, right? I mean, not even beyond. And Sunil then interestingly leaves us or central bankers with two choices, which is that either you create your regulatory framework for stable coins, so you regulate them, and or otherwise come up with your own currency, right? And I would like to hear Shashi, maybe from you first, on what option do you kind of personally like? What is the way to go for central banks?
I believe at this stage, what central banks are trying to do across the jurisdiction is they're trying to play catch up, right? They saw that stable coins have suddenly taken a lot of functions which otherwise fiat would have taken. Say in this case, a US dollar or GBP backed stable coins, primarily USD Tether and USDC. So they have to come up with some sort of digital currency. Now the unique thing about CBDCs are they are fiat, but only represented through digital means. They're not going to be different. They're not going to be a different currency for the country issuing it. They are essentially the same currency, only issued through a technological environment like blockchain and traceable and auditable. The funny thing about CBDCs is I'll actually go, rather than answering your questions directly, I'll point in a different direction.
Yes.
The motive behind issuance of CBDCs. I mean, why would a central government or a central bank issue CBDC? Paper currencies or fiats, in any case, are widespread, and you can use ATMs and a variety of even government's own digital platforms to transfer value. And less than, I believe, 5% actually travels through physical means in legitimate businesses, because everything is digital. So maybe the idea was probably to track and trace, and also kind of bring some sort of accountability within central banks, money supply system. However, in terms of monetary impact, rather impact on monetary systems or policies, we'll have to see how it progresses. But yeah, I mean, if you are holding CBDC in your wallet, it is fully traceable. So it helps the government trace when it was issued, whether it has gone through multi-layers of good, bad, and ugly holders, and where it's lying. And that this is one area where I'll be focusing on rather than the characteristic.
Interesting. So I mean, the way I would look at this is that for any currency of the future, there are two aspects or two components to it. One is the currency component, which is the used as a medium of exchange, and to that extent, I mean, the traditional function of money, right? But the other is the technology component of it. Increasingly, if currencies are going to be completely digital, completely interoperable with the, and in fact native to our technology ecosystems, then are governments best placed to really continue to be the drivers of, or the originators of these currency products. Is that a good reason for why we need private players to come in and innovate on the technology layer, the technology aspect of the currency? I'm happy to hear from any of you or all of you on this.
I'd like to add just one
Sam, go ahead.
Yeah, one point there, and then I'll hand over to you, Sunil. So I think from that perspective, if we look at banks and governments, cause some controversy here, they're not great at technology. They're good at creating things that work for a long time. If you look, most of the banking industry is still running on COBOL from the 70s. It's very difficult to upgrade and change these things because it's very risky. If you do something wrong, it can be catastrophic. But they're very good at compliance and setting frameworks and introducing regulation. So I feel as though we should work together, the governments and the banks and the central bodies work to create that framework, the legal system, the compliance, but we, as the technologists, we build the tech that works within those. Because most of this stuff, I think, even with, when we look at smart contracts and all of these things, it comes down to the legal side of things, the implementation. So if somebody is there to set the contracts, set the legals and the framework, everybody else can create the technology.
Yeah, I would just go one step ahead and say that we need to understand that regulation or governance itself is now shifting from human policy making to protocol governed frameworks, which means that if regulators or central banks or commercial banks are not abiding by or not building on-chain governance system, on-chain financial reporting system, on-chain transparency system, it means they will never be in a sound position to regulate. Which means whether they issue their own on-chain network currency, which should be some sort of a tokenized CBDC, retail tokenized CBDC, or they should bring private players which are more capable of increasing network of networks. For example, as Sam mentioned about Zomato, today you have hundreds and thousands of B2C networks where central banks are not that active. Even traditional commercial banks are not that active. But if there is on-chain governance model, on-chain supply model designed by a central bank, then this can be extended by all the private players. The problem here is that even the CBDC design model, which is currently getting popular, is number one, wholesale model, and that too non-blockchain model. The real sad story of this entire thing here is that despite speaking a lot about CBDC, the design model which central banks are talking about is either wholesale or non-blockchain, which is a kind of double fault. So the point here is that this catch-up game is going to turn into a lost game if blockchain friendliness is not built by central banks.
Yeah, and what like Sunil was mentioning, the design is very critical in any CBDC model, because ultimately you need to look at whether it is interoperable with other CBDCs, because every government or majority of governments would have their own set of CBDCs, and how do you do international settlements? So that aspect has to be there. So while whatever design a government chooses, ultimately it has to be part of certain predefined standards, so that it can be integrated at a settlement system level. So that aspect also has to be very well thought before any systems can be implemented on this.
And Sam, you were mentioning yesterday when we were speaking that stable coins can actually act as a good bridge for to enable CBDCs to become interoperable. Could you just elaborate on that a little bit?
Absolutely, yeah. So from that perspective, stable coins are they're well integrated into the various ecosystems. They have been around for a while, so they have a good adoption. The technology is relatively well proven. It's safe and secure. So rather than trying to bring a whole new class of currency to CBDCs and then reintegrating that into all of these existing channels, that can be leveraged as almost as another layer for this kind of, when we talk about inter-blockchain communication or IBC. So being able to transfer value from one blockchain to another, there's a really good use for stablecoins in that aspect, because they are the channels that already exist. So the question there is just, how do we handle going from a very kind of well-regulated, compliant coin into something that could be less well-regulated and compliant? That's probably the only open question there. But I think if we're able to solve that, and we're able to solve some of those issues around the audit and traceability, then stablecoins can provide as a really useful channel.
But why do we need multiple different kinds of stable coins, right? I mean, why could we not just be happy with the USDT? And maybe that takes us to a larger question on, clearly if there are, all these different experiments that are taking place, means that there are newer problems to solve for with newer stable coins, right? So could any of you maybe help us understand why do we need so many different stable coins? What are the kind of problems that we're trying to solve for through innovation on stable coins? And what kind of innovation will we keep seeing in that domain?
Yeah, and the issue here is that if you look at geographical distribution of fiat currencies, then you would find that the global monetary architecture is driven by nations, not driven by any global centralized body. So this is the precise ground from where the need for stable coins would emerge. If people who are comfortable with USD, they will prefer a USD stable coin. People who are comfortable with rupee payments, they will be comfortable with rupee stable coin, and so on and so forth. So the reality here is that we live in a zone which is by default a fragmented zone, which means if it is fragmented, then how to build on-chain identities. Now, on-chain identities, if they are to be anchored in particular fiat currencies, then this kind of multiplicity of stable coins is completely unavoidable.
And just to perhaps add a different spin on that, different asset classes. So stablecoins, when we talk about stablecoins, they don't necessarily have to be backed by fiat or something sovereign. They could be backed by anything that is tangible. So whether it's gold, whether it's invoices, whether it's property. So we effectively start opening ourselves up to having, I guess, different currencies that have different assets behind them, different profiles that doesn't typically exist, but we still have that in a system that we solve all of those kind of financial issues around, settlements and transference of value and avoiding double spending and these things. So we have that traceability of provenance, we have all of that auditability, but we're just changing the thing underneath that is securing it. So we start opening up our kind of toolbox now. We have a bunch of different tools backed by different things that we can start opening some really interesting options. So as you mentioned, having worked a lot in the fintech space, these are things we're exploring where you can take a contract such as a bill of lading in the shipping industry, and that is now the asset that is backing your effectively stable coin. The value of that coin is pegged to the value of that bill of lading or contract, and then that can be passed around the system.
If I add, sorry, Shashi, if I just
please go ahead.
Sam, the fact here is what Sam is telling right now is a site of Cambrian explosion for fiat currency use cases, because this is a zone where all the existing enterprise blockchain problems can be sorted out with monetary regulation and monetary collaboration. And this is a space where tourism, trade finance, global remittances, all those issues can be sorted out quite smoothly. So, but the problem here is that for that, central banks and regulators will have to build a blockchain-friendly protocol building capabilities. Every central bank, every commercial bank should have at least a dozen protocol developers as a core team. If they are not thinking like that, if they are not acting like that, then they will never be in a good position to regulate this entire scenario. Shashi.
Yeah. So I was just going to add on what Sam was saying, and Sunil has summarized a lot of things very beautifully. When you use multiple asset classes as collateral for any stable coin or anything, any issuance, the quality of that asset class has to be kept in mind. Otherwise, we might end up in what happened during subprime, that the collateral is so bad, and obviously you dress it up, you put it in nice ratings, etc. So this is unless we are careful, this will end up the future of some of the stable coins, obviously. Now I'll very briefly uh, go to the basics of a stable coin. I mean, obviously we have stable coins like Tether, where the supply is unlimited, because they well while I'm from crypto industry, so far I haven't understood what is the mechanism through which they decide how much to print. They printed, I believe, $1 billion yesterday. Then they're algo based, who actually control the supply, rather contract and expand the supply based on demand in the market. So between these and obviously other collateral based and some other based stable coins, we need to, again, I keep on going back to the same thing: collaterals, the quality of collaterals, how transparent and auditable it is. Because stable coins, what they have become is the issuer, instead of a government here, it's essentially a centralized third party. While they call themselves decentralized, there's no such thing as decentralized stable coin. It has to be a central authority which is issuing it. So we need to, when we talk about regulating stable coins, or looking at monitoring stable coins from a government perspective, we need to be careful of these things. That how deeply you can look at, how transparently you can verify things. If someone is saying that I'm holding reserves worth, say, 50 billion US dollars, whether it's actually there, or do they change it? So that ownership has to be there.
So, which Shashi brings us to a very important question, right? Which is the governance of stablecoin frameworks, and uh, what is the role of regulation there, right? I mean, so far, governance has typically in the crypto ecosystem largely been privately enforced, because through largely through a democratic process. But do you so one your thoughts on the core principles of governance that at least need to be embedded in any stablecoin framework. And second, do we need regulations to enforce those core principles? What would those regulations look like?
Uh, if we look at cryptocurrency evolution generally, they were created primarily to defeat the whole purpose of a centralized environment or centralized control of government over money supply. Now, it will be an irony that if we regulate, or governments try to regulate stable coins or any cryptocurrency in that way to control how the market functions. Obviously, I understand at times you would like to have investor protection built in. You like to have measures to monitor how much supply is going and who is doing how much movement. Now, coming back to stable coins operation or governance in general, uh, while a guidance from not necessarily individual government, because obviously a stable coin issuer would move from, say, country X to country Y, depending on, or wherever there is a favorable regulatory environment or regulatory leverage, which happens with current tax structures. Corporations move, the same will happen with stable coins as well. So maybe a broader international organization level, say, regulatory recommendations, like FATF is doing a fantastic work around recommending things of virtual asset service providers and virtual currencies, etc. Same can be with some kind of recommendation or guidance from FATF would actually serve a very useful purpose, rather than individual governments trying to enforce something. That's one side. Second, the whole control and governance of the stablecoin management itself. I mean, and this cannot be led by government. This has to be led only by participation of the broader crypto community. Unless the issuers of stablecoin are transparent about how they do things, what they do things, and whether the audit quality is reliable and not sketchy, not shaky. Because at times in the past we have seen that while reserves are claimed, uh, you cannot verify them. While it's claimed that you can redeem your stable coin for value in fiat, instances of that happening for broader masses is non-existent. So those things have to be thought carefully and enforced through the industry's participation, or at times when someone is not willing to participate, you start kind of sidelining them or boycotting them at industry level. So governance is very important and critical in a stablecoin environment. I'm not sure whether any central government level or any sovereign level enforcement or regulatory environment would help much in this. A global kind of environment would be much more favorable, I guess.
To add to what Shashi is saying, I would say that we should basically stick to one principle for governance and transparency, and that principle should be real-time financial reporting. For example, when we talk of Tether, Tether is on-chain asset, but it is backed by bank deposits and government securities, and then there is a regulator. The problem here is Tether is on-chain, but bank deposits are not on-chain, and regulator is not monitoring activity on-chain. So I'm saying all these three layers should be on-chain. That's where banks and regulators will have to pull up their socks.
Yeah, I see that Swati has popped up to take us back to the backstage, take us backstage. But well, this has been a fascinating conversation. I think the puzzle that I was trying to piece together is whether what's the way ahead, and can CBDCs and stable coins coexist? And what I'm kind of increasingly what I've believed in, and I'm hearing from the audience in different ways also, is like on one hand, Sunil says that, well, central banks are late to the party. They should have started doing this 3 years ago. Stable coins maybe today existing as a proxy. But also what other speakers kind of added to that, and what I believe is that central banks will continue to play catch up, and that's not going to end anytime soon, right? The technology is moving quickly. There are so many design choices that we also spoke about that the central banks across the world will have to take, and not all central banks are going to necessarily have consensus on that. So you will see different patterns emerging, different pathways emerging, and as a result, I think there is room for private actors also to coexist and co-innovate, right? That is probably the reason why we don't have just one or two stable coins, but multiple different stable coins. Yes, iterations, maybe marginal iterations, etc., etc. And there was a fascinating conversation that we were having on a panel yesterday on the private crypto ecosystem in the country. And my question to the panelists was that, well, I asked them to comment on the force fitting of blockchain to every kind of application that could otherwise even be solved by regular traditional databases, right? All force fitting NFTs today to every kind of application that could technically be just a simple blockchain or a regular database. And I got a very beautiful pushback on that, which is that it is not our job to really judge that what is the right use case that, for the time that we are living in. You call it force fitting, but it's ultimately catering to the needs of the market, right? And before the dot-com bust, there were actually internet companies that were trying to sell grocery online, and people were laughing at them, and obviously they all went bankrupt. But look at it today. So the point really being that, well, yes, I mean, these marginal iterations, over experimentation of sort in the stablecoin industry also will start to show color maybe 4 or 5 years hence. And you will see the same from governments and central bank actors also in the public space, and maybe both can coexist or both will converge at some point in time. But for now, at least, it seems like we are on the right path. So I'll end with that, and thank you very much, three of you. It's always been a pleasure talking to you. Thanks very much.
Thank you, Anirudh.
Thank you, everybody.
Shashi, Sam.
Thanks, Sam, Shashi, Anirudh. Yeah.
Thanks, everyone.
Well,
Bye-bye.
thank you so very much, everyone, for joining and making this session possible and being a part of Hodder. Thank you so much.
Thank you. Bye-bye.